What else do we notice about our opportunities when we segment in this way? Well, we find that the Hong Kong dollar and the Singapore dollar are the only Asian currencies without significant commodities exposure. So they're pretty diverse. The only ones that without significant commodities exposure that actually have a pegged or fixed regime. The Chinese yuan is the only commodity exposed currency that has a pegged or fixed regime outside the GCC, and that's pegged to the US dollar. And the Sing dollar and the Kuwaiti dinar are the only pegged or fixed regime currencies that don't disclose the weightings of the currencies they are pegged or fixed to. So here we've got our 36 currencies, our 36 potential opportunities, and we've put them all on the same page here, so it's easy for you to view. Here we've got Forex markets floating. Well, that's actually non-commodity floating, so what we've defined as floating regimes that don't have significant exposure to commodities. And then we have Forex markets commodity floating. So these are our 36 opportunities. And these are the ones that we're going to basically have to not consider as volatile opportunities. So we have here the ex-commodity pegged, which includes the Danish kroner, the Hong Kong dollar, and the Sing dollar, and the commodity pegged currencies. So these are the ones that are not going to move. There's no volatility, or volatility is extremely small. Another way in which participants, so conflict of interest participants in the Forex markets, segment currencies, is you will find brokers, investment banks, media outlets, so television, newspapers, online media, everything tends to get quoted against the big currencies. And the generic one is against the US dollar, because the US dollar is the world's reserve currency. So what you're going to find a lot of the time is everything is quoted against the US dollar, or it's quoted repeatedly against the US dollar. So, or by default. So the currency cross or pair that's generically quoted against the US dollar is called a dollar cross. And that can be any currency in the world. So let's have a look at one now. The Russian ruble, for example. At the time of writing, the Russian ruble was 62.35 to the US dollar. And the way you read that is $1 US equals 62.35 Russian rubles. So $1 buys 62.35 rubles, or it takes 62.35 rubles to buy $1 US. The dollar majors are termed majors because it's all the major currencies quoted against the US dollar. And these make up 85% of daily transaction volume in the Forex markets globally. And when you look at the major currencies, so we look at Euro, Yen, Sterling, Swissy, Canadian, Aussie dollar, Hong Kong dollar. When you look at the major currencies against the US dollar, these are the ones that make up the vast majority of daily transactions. And what you're going to see is a table quoted on all media outlets. So whether it's on television, on financial news channels, where you have the ticker dropping across the bottom of the screen, or whether it's online, or whether it's in the newspaper, you're going to see a table of cross rates, so currencies that are quoted against the US dollar. So we call these the dollar majors. And we're again falling into the trap here as retail traders Again, we're falling into this trap of segmenting currencies by the size of the economy or the size of the transactions that occur. And we have to be very careful, because what really matters, obviously, is, as we've pointed out, the volatility of these currencies. So you can see, for example, in the table here, this is every currency that's quoted against the US dollar. These are known as the dollar majors. Cross rates, specifically cross rates, are defined as the currencies that are not quoted, the cross rates that are not quoted against the US dollar. Cross rates are quoted as the majors against each other. So, for example, we have here the Canadian dollar quoted against the rest of the major currencies. So the Canadian dollar here buys 95.859 Japanese yen. And this is the table, when you combine the whole lot, this is the table that you're going to see all the time in general media outlets, the dollar majors and the cross rates. But we know better now. We know that when we see this, this doesn't mean what we're looking at is a table of opportunity. The table that we're looking at is just major currencies against the US dollar and against themselves. And that doesn't necessarily equal volatility, opportunity, and risk. So we segment in a different way. As professional traders, we have to segment based on what the currency is dependent on and what regime the currency is part of. That's the first step we take. So we're going to build this out further as we go through the video series, but we've taken a very important first step in defining exactly how professional traders group their currencies, and those groupings are based on the principle of seeking out volatility, so opportunity and risk. So we've taken that first step. We'll build out further, and what we have to do next will be concentrating on really understanding the differences between Forex regimes, so the fixed versus the floating regime. Okay, so welcome back to the desk. What you just saw there was the first real step to understanding and getting a foundation in the global currency markets, which is actually to look at the opportunity set that the global currency markets present to us as traders. And that first step is really understanding definitions. When you see, for example, as a retail trader, a daily rundown sent to you by a brokerage company or a media company, like on television or in a newspaper or even online, what you'll find is that all of these people, all of these companies, they group currencies based on these popularized and predetermined definitions. And what you saw on the computer screen was an example of how they all do this. So grouping all of the dollar crosses into one area, grouping all of the non-dollar crosses, so the euro crosses, the yen crosses, the sterling crosses, all into one area. And it's all really predetermined by the size and geography of the countries and currencies themselves. So big countries are put over here. So big countries against the US dollar, big countries against each other. And as a retail trader, you get hammered all the time with these definitions. And it's actually the wrong way to look at things, as we discovered. And the way professional traders look at things is they actually start splitting up things immediately into definitions which perpetuate a definition that is anchored to volatility. And the first step we took there was to look at the different regimes and look at what the currencies are actually connected to. So we're not really caring about the size of the economy at the moment. We're not really caring about the geography. What we're caring about is what regime is the currency, and is there an opportunity there? So fixed or floating, and are they connected in any way to a commodity or maybe two commodities? And we do that because volatility is subjective to the concentration of being exposed to one or two or a multitude of factors. So what we did was we split up the 46 currencies that we have available there in that opportunity set, and split them up in a way that defined them by potential volatility. Now that's just the first step. We're going to move on as we progress through foundation into defining these currencies further on a volatility basis, not on a size of the economy or geography basis. It's very key to understand that everything we do as professional traders needs to be focused on capturing volatility. So we will build this out further, but for the moment, just take the basic principle as professional traders have to capture the volatility. So we've taken the first step. So we've defined the opportunity set and defined the definition. The next thing we're going to do is really understand the difference between fixed and floating regimes. You need to understand the history of Forex and get a really strong foundation of the differences between fixed and floating regimes.